All right, let's dive into RLJ Lodging Trust's second quarter earnings for 2025. This one's interesting because on paper, the news looked pretty good, but for the stock, it was a rough day. We're going to figure out exactly why.
So check this out. On the one hand, RLJ Lodging Trust delivered a solid quarter, beating the key bottom line estimates by over 4%. You'd think that's a win, right? Well, the very next day, the market just hammered the stock, sending it down almost 6%. And that's the puzzle we're going to solve today.
So this is the big question, isn't it? If the results looked good, why the huge sell-off? It's pretty clear the market was reacting to something a lot deeper than just the headline numbers. It was listening really closely to what the company said was coming next.
And this slide right here starts to show you the mixed signals. Yeah, the adjusted FFO per share, that's funds from operations, which is a super important metric for real estate companies, it was a solid 48 cents, beating what everyone expected. But take a look at the top line. Revenue just missed expectations. And maybe more importantly, comparable RevPAR, that's revenue per available room, was actually down 2.1% from last year. And that's our first big clue.
Okay, first, let's unpack the bear case. This is all about why investors got so nervous and started selling. It all comes down to the short-term outlook. Right. Here's the breakdown of the problem. Management talked about what they called a layering effect of challenges all hitting at once in the third quarter. I mean, it's a laundry list. They're up against tough comparisons to last year, which had the Democratic National Convention. Plus, they're comparing against a time when hurricanes drove business to their hotels. On top of that, major renovations are taking rooms offline. A big convention center in Austin is closed. And to top it all off, group demand is just softer. You can see how Q3 is starting to look pretty messy. And if there was any doubt about how serious this was, the CEO, Leslie Hale, basically put a number on it. This quote from the earnings call was a massive red flag for Wall Street. Hearing that July RevPAR was already tracking down by mid-single digits, well, that just confirmed that these headwinds aren't theoretical. They're real and they're happening right now.
And it wasn't just a revenue story. Their profit margins got squeezed too. Hotel EBITDA margins compressed by 90 basis points. That's almost a full percentage point. Now, that might not sound like a disaster, but when your revenue is already looking weak, any drop in profitability gets a ton of scrutiny. It showed that even with their aggressive cost-cutting, it just wasn't enough to fight off the pressure.
But hold on, that is only one side of the coin. Let's flip it over and look at the bull case. This is management's argument for why everyone should look past this little rough patch and focus on the long game. So the company's not just sitting back and taking it. They're focused on three key things. First, they actually kept their operating expense growth flat compared to last year, which is really impressive. Second, their whole strategy of converting hotels to different brands, it's working. Those properties saw a 10% jump in RevPAR. And third, all those renovations causing short-term pain, well, that's part of a bigger plan to position those hotels for much higher earnings down the road. And while the overall portfolio was down, there were some serious bright spots. Just look at San Francisco. They're calling it an AI-led tech revival. And combined with a strong calendar of citywide events, their RevPAR in downtown San Francisco surged an incredible 20%. It just goes to show that in the right markets, their urban strategy is absolutely crushing it.
So this timeline really pulls the whole story together. Management is basically telling investors, look, just get through Q3 with us. That's the bottom. They see a recovery starting in Q4 as the comparisons get easier and those renovations start paying off. And then 2026 is just loaded with huge catalysts. We're talking the Super Bowl and their key San Francisco market, the World Cup, the US 250th anniversary, all happening when there aren't a lot of new hotels being built.
Okay, so we've heard the bear case, that's all about the pain in Q3. And we've heard the bull case, that's looking way out to a big 2026. Now it's time for our take, what we think is going to happen on the next call. For Q3 RevPAR, we're forecasting a drop of about 5%, which is right in line with what management told us to expect. For the full year, we think FFO per share will probably land somewhere around $1.40, especially since management themselves guided towards the bottom end of their range. As for the stock price, we think it's going to be pretty much stuck in a range. The bad news for Q3 is probably already baked in, but those huge catalysts in 2026 are still just a little too far away to get people really excited just yet. So our final rating here is market perform. The company is doing a good job managing what they can control, but those near-term headwinds are just too big to ignore. They'll probably keep a lid on the stock until that path to 2026 growth gets a whole lot clearer. So really, the key question for investors is pretty simple. Can you be patient enough to wait through a tough quarter for that potential payoff in 2026? We'll definitely be watching. And just as a final reminder, this is not financial advice.